Good day everyone. Welcome once again to another episode of tax training. And today I will discuss to you about accounting for income taxes. Why? Because when you file your income tax return, you are going to file some reconciliation between accounting income and taxable income. So this episode will tell you how you are going to recognize the deferred tax assets and the deferred tax liabilities for income tax purposes that you are going to reconcile in your income tax return. But before that, I would say thank you to our subscribers. Umabot na po tayo ng 2,740 and thank you for your support. Expect that we will be bringing to you more videos, more topics on income tax that will help you in your filing of income tax return that will make or bring you better tax compliance. So accounting for income taxes, the topics that I am going to discuss to you are the principles and concept of the income tax, the permanent and temporary differences, and the methods of accounting for income tax. So for the principles and concept of the income tax, the taxation is a power of the state which is more powerful than any other three powers. The strongest of all power of the state is the power of taxation. So the power of taxation is also a legislative process and a mode of government cost distribution. Why distribution? Because all the citizen and people residing here in the Philippines are taxed so that they will help in the expenses of the government. As a state power, income tax, it is inherent in the power of the state to enforce a proportional contribution from its subject for public purpose. So the state has the power, has the inherent power, meaning even if it is not embodied in the Constitution, still the state has an inherent power to enforce contribution of taxes. As a process, it is the levying of taxes by the legislature of the state to enforce proportional contribution from its subject for public purpose. Since taxation is a law, then without the legal basis, we cannot impose the law. Also, it is the legislature. So, manggagaling talaga siya sa Congress, it will emanate from the Congress sa ating mga House of Representative, and then it will go through the process para magiging batas yung ating taxation law. As a mode of cost distribution, the state allocates its cost or burden to its subjects who are benefited by its spending. So, kasi nga sinasabi natin, lahat dapat tumulong sa pag-support sa ating gobyerno. That's why all consumers, all taxpayers are helping in paying taxes to support the government. So, allocates its burden. So, ibig sabihin, dinidistribute yung burden to support the government to its citizens. So, for business taxes, especially value-added tax, it's the consumer who shoulder the value-added tax. For income tax purposes, all persons earning income should pay income tax. And for your information, of all the national taxes collected by the government, income tax contributes more than 50% of the total revenue to support the government. Why? Because almost everybody who are earning income tax are contributing to the budget of the government, so that the national government are collecting more than 50% of its revenues coming from the income tax. So we can say that income tax is the most important tax of all the national taxes. Why? Because of its contribution, which is more than 50% of the total collection of the BIR. So gross income, when we say gross income, we mean taxable income, which refers to certain items of gross income, less deductions and personal exemptions allowable by law. So this time, the exemptions allowed by law, which is zero rate, the non-taxable income is 250,000. So gross income also pertains to any income that can be subjected to income tax. So gross income, any income that can be subjected to income tax. Gross income can also be defined as any inflow of wealth to the taxpayer from whatever source, legal or illegal, that increases net worth. So, any inflow of wealth, basta pumasok yan sa pocket ng isang tao, that is taxable as gross income. It includes income from employment, trade, business, or exercise of profession, income from properties and other sources. So any kind of sources of income, the sources, regardless of the sources, the income, gross income is taxable. No? So whether it is from employment, because employment, your salary or compensation is taxable on gross compensation income. For trade or business, they're taxable as net income or gross income depending on your method of deductions used, or from your exercise of profession. Also, if you own properties and you sell your properties, it is also taxable as capital gains. Capital gains is not a classification of tax, but it is income tax. So capital gains tax are income tax. Only that it is being earned when you sell your properties and other sources. So we have to distinguish now what are the permanent and temporary differences in accounting for income taxes. Why? Because there are differences between accounting income and taxable income. When this taxable income and accounting income arise, the differences arises when the differences are classified as permanent difference or temporary difference. Also, it can be permanent difference or temporary difference. The difference that arose when there is accounting income and that there is also taxable income. What is accounting income and what is taxable income? Taxable income arises when the income that you earn are subject to tax. Accounting income, you earn income, but some of that income are not taxable. So for accounting purposes, you are earning the income, but for tax purposes, that income is not recognized for tax purposes because it is not subject to tax. Okay. So we have to know what are the permanent differences. For permanent differences for income and taxable income and accounting income, permanent differences are items of revenue and expenses which are included in either accounting income or taxable income but never on both. So, permanent differences included siya sa accounting income pero hindi sa taxable income. Or it can also be na included siya, taxable income siya, but never siyang ma-include doon sa accounting income. That is permanent difference. Also, permanent difference can pertains to non-taxable revenue and non-deductible expenses. Why permanent? Kasi it will never be taxable. Why? Because by nature of its income, it is not taxable. The law grants exemption on that income, so it will never be taxable. So, when it comes also to expenses, it is always non-deductible. So, it is permanently not subject to tax. But it should be included in your accounting income. Permanent difference also did not give rise to deferred tax asset and liability because they have no future tax consequences. So, hindi siya kasama sa deferred tax asset and deferred tax liability because wala siyang future tax consequences because it will never be taxable for income tax purposes. So, what are the example of permanent differences? The example given here are interest income on deposits. Why interest income on deposits? Because interest income on deposits are subject to final tax and we will never account it when we file our income tax return. Another are dividends received. So this income are also not subject to tax. Why? Because they are subject to final tax. Final tax of 10% when received by an individual. But when received by a domestic corporation from another domestic corporation, then dividends are exempt. Life insurance premium. When is life insurance premium permanent difference when it comes to tax purposes, because it is not subject to tax? Life insurance premium is permanent difference. It is not subject to tax when the entity is the beneficiary of a life insurance policy or an officer or employee. The premium paid by the entity is not deductible as expense for tax purposes, but said premium is an expense for financial reporting purposes. For financial reporting purposes, that is deductible, that can be recognized, but for tax purposes, the premium is not deductible. Why? Kasi that is a life insurance policy of the beneficiary. Also, for tax purposes, it is not recognized. Another are tax penalties, surcharges, and fines are non-deductible. For tax purposes, all penalties, surcharges, fines, penalties incurred for late filing of return or taxes, they are not deductible. So what are you going to do that is only deductible and recognized in accounting income. Why? Because that is a deduction to retained earnings. But for tax purposes, it will never be recognized. Temporary differences. So what are these temporary differences? We have discussed the permanent differences, that it has no effect on the tax liability, future tax liability of the company. So for temporary differences, these are differences between the carrying amount of an asset or liability and the tax base. So what are the carrying amount of an asset? Why? It is important because we have to report it in our financial statement, especially in our balance sheet, statement or financial position. No? So the temporary differences include timing differences, which give rise to deferred tax liability and deferred tax asset. So the temporary differences are accounted for. And actually, in our discussion, we will be discussing to you and give you example on the temporary differences. Okay. So temporary differences arising from timing differences are differences between accounting income and taxable income that originally in one period and reverse in one or more subsequent periods. So it happens in one, it originates in one period, but since it is just a timing difference and temporary difference, it will reverse in another period. So the items of income and expenses which are included in both accounting income and taxable income but at different time periods. So sinama siya sa accounting income, hindi pa muna siya sinama sa taxable income, but later on sinama din, but at different time periods, hindi sabay. Okay. So what are the kind of temporary differences? The taxable temporary differences which result in future taxable amount in determining taxable income of future periods when the carrying amount of the asset or liability is recovered or settled. So in this case, this taxable temporary difference should be disclosed in the financial statement and should be included in our balance sheet. It should be reported. Another is the deductible temporary difference which result in future deductible amount in determining taxable. So these are deductible temporary difference and taxable temporary difference. Now for deductible temporary difference, resulting in future deductible amount in determining taxable income of future periods when the carrying amount of the assets or liability is recovered or settled. So deductible siya. So there are benefits for tax purposes. So tax base. What are the tax base? The tax base of an asset or liability is the amount attributable to to the asset or liability that is recognized or allowed for tax purposes. So for tax purposes, our tax base of an asset or liability are the amounts attributed to the assets or liability. We have to determine what are the amount attributable to the assets. So we have examples later on, especially on revaluation, wherein the asset increased its value. And for tax purposes, what are the consequences of that we have to recognize and report? So the tax base of an asset or liability is recognized or allowed for tax purposes. So that is very important. When are we going to recognize and report that in our income tax return? Tax base of an asset, amount that will be deductible for tax purposes against future income. So it will not be deductible in the current income. And when does this happen? No, we will discuss that. So example, the entity has appropriately capitalized 1 million as software development cost. So this is a capital expense for software development, 1 million. The carrying amount is 1 million for accounting purposes. So for accounting purposes, they recognize the carrying amount of the software development for 1 million. If the amount is allowed as one-time deduction for tax purposes, or you expense the 1 million, the tax base is 0 because the entire amount is expensed in the current year. So there is no point that you are going to allow it as or defer it for another period or taxable year because you expense it on the current year. So there is no more tax base because you expense it already. Tax base of a liability, normally the carrying amount less the amount that will be deductible for tax purposes in the future. So, what is the tax base of the liability? Carrying amount less amount that will be deductible for tax purposes in the future. Why? Because you defer that. You defer the tax liability. Example, an entity has recognized an estimated warranty liability of 500,000. The carrying amount is 500,000 for accounting purposes. But estimated warranty cost is deductible only when actually paid. So even if you recognize that there is already an estimated warranty for 500,000, it is not recognized for tax purposes. Why? Because it is recognized only when actually paid. No? Because in the accounting, it is only estimated. But for tax purposes, when it is actually paid. So in this case, the tax base is 0 because the estimated warranty cost is a future deductible amount. So for tax purposes, the tax base is 0. Why? Because you are not going to deduct it at the current year. So deferred tax liability. This is the amount of income tax payable in future periods with respect to a taxable temporary difference. So we call that as a deferred tax liability. Why deferred tax liability? Because it has to be paid in future period. It is not payable now. So that is your future or deferred tax liability. So it is deferred tax consequence attributable to taxable temporary difference or future taxable amount. Okay? So deferred tax liability arises from when does deferred tax liability arises, or when does this deferred tax liability happens? When the accounting income is higher than taxable income because of timing differences. So mataas yung accounting income mo kaysa sa taxable income. So anong mangyayari? Because there is a timing difference. So anong mangyayari? There is a deferred tax liability. Kasi mataas yung income mo, accounting income, pero mababa yung taxable income mo. May future tax liability ka when that accounting income should be recognized now for tax purposes. So when the carrying amount of asset is higher than the tax base. So what is the carrying amount of the asset? higher than the tax base. So meaning, when the carrying amount of the asset is higher, and then the tax base is lower, you have a deferred tax liabilities, especially if that carrying amount of the asset, increase in carrying amount of the asset will be recognized for tax purposes. So you have a deferred tax liability. When the carrying amount of the liability is lower than the tax base, what is this carrying amount of the liability? Right now, on the current year, you are not going to recognize that as a liability, but sooner it will be recognized as a tax base for tax purposes, and then the tax liability will arise. So that is a deferred tax liability, meaning you have to recognize that in the future period, not on the current year. Accounting income higher than taxable income. So, higher yung accounting income, lower yung taxable income mo. What happens? Revenues and gains are included in accounting income of the current period but are taxable in future periods. So, accounting income mo higher, pero yung taxable income mo lower because the other income recognized in accounting income are not yet taxable. Example, installment sale. So, installment sale included in accounting income at the time of sale and included in taxable income when cash is collected in future periods. So, for installment sale, once the transaction is consummated, you have to recognize now the sale for accounting tax purposes. But since it is not yet paid, it is not yet considered taxable, so it is not included in your taxable income. Expenses and losses are deductible for tax purposes in the current period, but deductible for accounting purposes in future periods. So this is the case wherein the taxable for tax purposes, expenses and losses are already deducted, but for accounting purposes in the future period pa. So, hindi sila magkatugma, no? Kaya nga ang tawag dito, temporary differences. So, what are the example on this? We have the accelerated depreciation for tax purposes and straight line depreciation for accounting purposes. So, when we say accelerated depreciation, higher yung beginning year, no? While on the straight line depreciation, the same lang yan throughout the life of the asset. So, since higher yung taxable income for magiging lower, pag accelerated depreciation, mataas yung dinidak mo, so maliit na lang yung income mo. No? So, hindi sila magtugma doon sa accounting income. Another example for expenses and losses that are deductible for tax purposes pero hindi pa nire-recognize sa accounting purposes of future period pa. Another example are the development costs that may be capitalized and amortized over future periods in determining taxable income in the period in which it is paid. So, prepaid expense has already been deducted on a cash basis in determining taxable income or the current period. So, prepaid expense has already been deducted on cash basis, no? In determining taxable income for the current period. Ano ba tong cash basis? The recognized revenues and expenses at the time it is paid in cash. So for determining taxable income, the cash basis already taxed or recognized or deduct the expense. But it is prepaid expense, so for accounting purposes, it is not yet included as a deduction. So, other taxable temporary differences that are not timing differences. So, the asset is revalued upward, meaning there is an increase in the value of the assets. And no equivalent adjustment is made for tax purposes. Why no adjustment is made for tax purposes? Because it is not recognized for tax purposes. The carrying amount of investment in subsidiary, associate, or joint venture is higher than the tax base because the subsidiary, associate, or joint venture has not distributed its entire income to the parent or investor. So this is another example, no? why the carrying amount of investment in subsidiary, associate, or joint venture is higher than the tax base. Because the subsidiary, associate, or joint venture, hindi pa nila na-distribute yung income to the parent or investor. Kaya nandun pa sa kanila. Kaya higher yung amount of investment na sa kanila. Hindi pa kinuha ng parent company. The cost of a business combination that is accounted for as an acquisition is allocated to the identifiable assets and liabilities acquired at fair value. So there is a business combination. Maybe the company is undergoing some restructuring. No? So there is a business combination accounted for as an acquisition. No? It is already allocated to the assets and liabilities acquired at fair value. Recognition of a deferred tax liability. So when are we going to recognize the deferred tax liability? We have Philippine Accounting Standards number 12, paragraph 15. It provides that a deferred tax liability shall be recognized for all taxable temporary differences. So ano po yung ni-require ng Philippine Accounting Standards number 12? For all taxable temporary differences, the deferred tax liability shall be recognized. So you are going to recognize, disclose it in your financial statements. No? A deferred tax liability is not recognized when the taxable temporary differences arises from. These are the exemptions to the requirement of the Philippine Accounting Standards number 12. And what are these? Goodwill resulting from a business combination and which is non-deductible for tax purposes. No? So goodwill, hindi siya pinapa-recognize sa atin. Another, which you should not recognize for taxable temporary differences. Initial recognition of one asset or liability in a transaction that is not a business combination and affects neither accounting income nor taxable income. So, if there is only initial recognition of asset, no, or liability transaction, pero hindi naman siya business combination, there is no restructuring that happens, and it does not affect accounting income or taxable income, then you are not going to recognize it. Undistributed profit of subsidiary, so hindi mo rin to i-recognize. The profit of the subsidiary which is not distributed, profit of the associate or joint venture, when the parent investor or venturer is able to control the timing of the reversal of the temporary differences. Why? Because the investor has the control over the subsidiary and the timing of the reversal of the temporary difference. So, depende yan sa investor kung kailan niya sasabihin. Kasi under control niya yung kanyang subsidiary. And this is in terms of undistributed profit of the subsidiary. So if it is not distributed, nandoon pa yan sa written earnings. You are not going to recognize that as taxable temporary differences. Okay, so let's now go to deferred tax assets. When we say deferred tax assets, these are the amount of income tax recoverable in future periods with respect to deductible temporary differences and operating loss carry forward. When we say assets, may future benefits pa. Kasi hindi pa siya gamit, no? Kaya dineferred lang yung tax assets. But in the future transactions that can be applied, that can be used against your tax liability. The deferred tax consequence attributable to future deductible amount and operating loss carry forward, this is also deferred tax assets, arise from the following. These are the example. When the taxable income is higher than accounting income because of timing differences. So taxable income higher than accounting income, and the reason are timing differences. No? Why timing differences? Because accounting income recognize already the income, but for taxable income, the taxable income does not recognize it. So timing differences. Another, when the tax base of the asset is higher than the carrying amount. So the tax base of the asset is higher than the carrying amount, so there is a deferred tax asset. When the tax base of a liability is lower than the carrying amount, so the tax base of the liability is lower than the carrying amount, so there is a deferred tax asset. So what happens when the taxable income is higher than accounting income? So what happened? Mataas yung taxable income mo, pero mababa lang yung accounting income mo. So the revenues and gains are included in taxable income of current period but are included in accounting income of future period. So currently, yung taxable income, kasama na doon yung revenues and gains, pero sa accounting income, hindi pa niya sinama sa future period pa. No? Example, the rent received in advance is taxable at the time of receipt but deferred in future period for accounting purposes. Why? Why for accounting purposes, dinefer pa yon? Although it is already received, because it is not yet earned. Why? That's why the proper classification is it is still a liability. Why? Because it is not yet earned, because that would be rent for the future period. So for accounting purposes, since it is not yet earned, so for accounting purposes, it is not recognized as an income. But the rule is different when it is taxable income. Why? Because the government know that the money is already in the pocket of the lessor, so that the law mandates that whenever you receive the rent, you should pay the tax already. Why? Kasi nasa disposal na ng lessor yung pera. So, dapat bayaran na rin niya yung tax. No? Expenses and losses are deducted from accounting income of current period but are deductible for tax purposes in future period. So, expenses and losses. For accounting income, future pa. For tax purposes, for accounting income, current period na, ni-recognize na, but for tax purposes, future period pa. So, ito yung difference. Okay. So, future deductible temporary differences. Ano ito mga future temporary differences? Hindi siya current. Probable and measurable litigation loss is recognized for accounting purposes but deducted in determining taxable income when actually incurred or paid. So always, for accounting purposes, recognize already the litigation loss. But for taxable income, since it is not yet incurred or paid, wala pa. So it is not yet recognized. No? Estimated product warranty cost is recognized for accounting purposes in the current period but deducted in determining taxable income when actually incurred or paid. So this warranty cost, the accounting can already set up the liability for warranty. They can fix it at a certain amount. But for taxable income, it will only be recognized when it is actually paid or incurred. No? Pag hindi pa siya i-recognize. Okay, research cost is recognized as expense in determining accounting income but not permitted as deduction in determining taxable income until later period. Ano to mga research cost? These are research and development costs that are deferred or that are capitalized. It is not recognized as an expense of the current period. Why? Kasi it would be taxable only on the later period. So usually this research cost kinakapitalize, no? Depende to sa kung ano yung ginagawa nila on the research, no? Depending on the outcome. Okay, so an impairment loss is recognized for accounting purposes but ignored for tax purposes until the asset is sold. So ano tong impairment loss? Na deteriorate, bawa yung machine. No? So it is recognized for accounting purposes. Ano pa itong na-impair? The inventory. No? So wala nang value. So impaired na. So for accounting purposes, you can already recognize that. But for tax purposes, no. Only until the asset is sold. Kung nabenta na yung asset and then nalugi, saka pa lang. Pero, at the moment na hindi pa naman binibenta, nandyan lang yung assets, it is not recognized. No? The impairment loss. Doubtful accounts are recognized as expense for accounting purposes, but deductible for tax purposes only when written off as worthless. So there are requirements for the written off of the doubtful accounts or these bad debts na tinatawag. No? For tax purposes, you can only deduct these doubtful accounts kung na-determine mo na worthless na talaga sila and it is actually written off. But for accounting purposes, they are already recognized as doubtful accounts. So, expense mo na sila for accounting purposes. Other deductible temporary differences, the assets is revalued downward, meaning nag-decrease yung amount or value ng assets. No? And no equivalent adjustment is made for tax purposes. Why? Kasi the revaluation is only in paper. No? It does not affect the taxable income. The tax base of investment in subsidiary, associate, joint venture is higher than the carrying amount because the subsidiary, associate, or joint venture has suffered accounting losses in current and prior years. So, walang kinita yung mga subsidiaries. So, the tax base of investment in subsidiary is higher than the carrying amount. No? Okay. So, recognition of deferred tax assets. Paragraph 24 of Philippine Accounting Standards number 12 provides that a deferred tax assets shall be recognized for all deductible temporary differences and operating loss carry forward when it is probable that taxable income will be available against which the deferred tax assets can be used. So, kailan daw yung deferred tax assets shall be recognized? Sa temporary differences and operating loss carry forward. No? Why? Because it is already probable that taxable income will be available against the deferred assets can be used. So, pwede mo nang gamitin yung deferred tax assets mo. You can apply it for income tax purposes. Operating loss carry forward. This is an existing tax deductions over gross income in a year that may be carried forward to reduce taxable income in a future year. So, we have this, what we call as NOLCO, or the net operating loss carry over, and we can use it only for a period of 3 years, after which the right to use this operating loss carry forward already expired. So, hindi na pwedeng gamitin, no, yung operating loss carry over. Certain entities registered with the Board of Investment are permitted to carry over net operating loss for tax purposes, subject to limitations of the relevant laws and implementing regulations of the Board of Investment. So, meron silang another or a different time period in order to recognize and then use this operating loss carry forward. So, what are the method of accounting used for this accounting for income taxes? We have number 1, the income statement approach. So, what does this income statement approach do? The income statement approach, the method focuses on timing differences only. So, for income tax statement approach, it focuses on timing differences only in computation of deferred tax assets or deferred tax liability. So, timing differences lang yung nire-recognize niya. Timing differences affect the income statement of one period and will be reversed in the income statement of one or more subsequent periods. So, kaya timing difference siya eh. So, kung i-recognize mo siya ngayon or hindi mo siya i-recognize, that will be reversed in the income statement of one or more subsequent periods. Okay. For the statement of financial position approach, you have to consider all temporary differences, including timing differences. Sa income statement approach, only the timing differences that affect income tax of one period will be reversed, no? So dito naman sa statement of financial position approach, all temporary differences, including timing differences, are recognized. So there are temporary differences that affect the statement of financial position only, and technically are not timing differences, but nonetheless are recognized in computing deferred tax assets or liability. Okay, so that is under the statement of financial position approach. So what are the accounting procedures for inter-period tax allocation? It is the recognition of deferred tax assets or deferred tax liabilities inter-period, so within the same period. Step 1, determine the taxable income. So you are going to determine how much is the taxable income. You are going to compute. And how are you going to arrive at the taxable income? Then you have the gross sales less direct cost equals gross profit less operating expenses equals taxable income or the operating income. The taxable income multiplied by the tax rate equals the current tax expense. So how much is your taxable income? You multiply that by the rate of the current tax expense equals your income tax expense on a certain amount, and credit your income tax payable. So these are the entries on how to determine the taxable income. So when you recognize that the current tax expense, the entries are debit income tax expense, credit income tax payable. Why payable? Because it is not yet paid. Current tax expense is the amount of income tax paid or payable for a year as determined by applying the provisions of the enacted tax law to the taxable income. So what are the current tax expense? The amount of income tax paid or payable for the year. Okay, so in this case, we are applying the provisions of the tax laws. So our current tax laws is the train law, which increases or decreases the rate of income tax for individual, but the rate of corporate income tax are just the same. So no changes for corporate income taxes. The next step, step 2, determine the taxable temporary differences. The amount of taxable temporary differences multiplied by the tax rate equals the deferred tax liability. So, with the snap of your hand, meron ka na. And how are you going to record that? Debit income tax expense, credit deferred tax liability. So, once you have determined the taxable temporary differences, then multiply that by the tax rate equals the deferred tax liability. And how are you going to record that in your journal entries? Income tax expense, debit, credit, deferred tax liability. Okay, step 3, determine the deductible temporary differences. The amount of deductible temporary differences multiplied by the tax rate equals the deferred tax assets. Bakit itong temporary differences? Because ito yung nag-cause na you defer your tax assets. So what are the entries? Deferred tax assets, credit income tax benefit. Okay? The income tax benefit account reduces the current tax expense for the year and is a deduction from current tax expense. So, why income tax benefit? Kasi, meron ka ng deferred na tax asset noon at in-apply mo siya ngayon. So, you are benefited. The current year is benefited. So, it reduces the current tax expense for the year kasi recognize na siya noon as an asset. No? So, you use it now, the current tax expense for the period, as a deduction from current tax expense. So, you are benefited. Kaya ang tawag sa kanya, income tax benefits. No? The deferred tax asset may be credited directly to income tax expense. So, the deferred tax assets, pwede rin siyang directly credited to income tax expense. Step 4. The total income tax expense for the year is the current tax expense plus deferred tax expense arising from taxable temporary differences minus the income tax benefit arising from deductible temporary differences. So, merong plus, merong minus, no? Meron tayong mga computations na example. Total income tax expense for the year is equal to the accounting income subject to tax multiplied by the tax rate, no? So, assuming there is no future income enacted income tax rate. So, our current tax rate is 30% for corporations. And for individual, the maximum rate is 35%. But for individual also, the first 250,000 is zero rate, meaning it is not subject to tax. So, example for the deferred tax liability. In 2019, IMCAN, this is an entity, a business entity. An entity reported in accounting income a gross profit on installment sale of 2 million. So, gross profit. How did you arrive on the gross profit? The sales less cost of sales equals gross profit. Or, if you are selling services, then gross receipts less cost of services equals gross profit. So, the temporary difference is expected to be reported in taxable income equally in 2020 and 2021. No? So, dun sa installment sale ng 2 million. Temporary differences is expected to be reported in taxable income equally in 2020 and 2021. So, the income tax rate is 30%. That is for corporation. It is not changed until now. So, for 2019, the accounting income is 5 million and the taxable income is 3 million. For the year 2020, the accounting income is 6 million, the taxable income is 5,500,000. For 2021, the accounting income is 8 million, the taxable income is 7,500,000. So throughout the years, the accounting income is not equal to taxable income. Palagi silang hindi magkapareho. So, since the temporary difference results to a higher accounting income in 2019, there is a deferred tax liability. Why deferred tax liability? Kasi malaki yung accounting income mo compared to the taxable income. So, the journal entries in 2019 to record the current tax expense, you have to debit income tax expense by 900,000 and income tax payable by 900,000. No? So, how are you going to compute that? The 900,000, this is the 3 million income multiplied by the tax rate of 30%. No? So, to record the deferred tax liability, you are going to debit income tax expense 600,000 and then the deferred tax liability 600,000. So in the journal entries number 1, you record the income tax expense which is 900,000 and the income tax payable for 900,000. And the deferred tax liability is 600,000. The deferred tax liability is credited and computed as 2 million times 30,000. So, 30%. So, we have 600,000. The deferred tax liability. Okay. So, income tax payable is classified as current liability and the deferred tax liability is classified as non-current liability. So, what is the difference between the current liability and the non-current liability? For the current liability, they are supposed to be settled within the taxable period or within the year. Non-current liability, they are not expected to be settled during the year, but in some future period. Okay. So, income statement presentation for 2019. So, these are the example. In our example previously, we have the income before income tax of 5 million and we have our income tax expense. So the current expense is 900,000 and there is a deferred tax expense of 600,000. So the total income tax expense is 1,500,000, so that the net income is only 3,500,000. Observe that the accounting income subject to tax of 5 million multiplied by 30% equals 1,500,000, which is the total income tax expense for the year. But as to the treatment, the 1,500,000, 900,000 of that is a current tax expense, while the 600 is a deferred tax expense, meaning it is a tax expense in the future period. So the journal entries in 2020 for the same transactions to record the current tax expense. So you have to debit income tax expense 1,800,000, credit income tax payable 1,800,000. So how did you arrive on that? The net income of 6 million multiplied by the 30% tax rate. And then number 2, we have the decrease the deferred tax liability. Debit deferred tax liability 300,000 and credit income tax expense by 300,000. So you are going to decrease now the deferred tax liability because you are going to apply it in your current year. You have to use it. So the deferred tax liability is arrived at by multiplying 1 million by 30%. So the income statement presentation for 2020. Income before income tax is 6 million. So you have to compute the income tax expense. For the current tax expense, 1,800,000. Okay. So there is a decrease in deferred tax liability of 300,000. So how much is the net income? 4,500,000. Why? Because you are going to deduct from the 6 million, the 1,500,000 as income tax expense. So since you are going to deduct your income tax expense from your income before income tax, then you have now your net income. This net income is the one that you are going to put in the retained earnings. So journal entries in 2021. To record the current tax expense, you have to debit income tax expense and credit income tax payable on the amount of 2,400,000. This is 8% times 8 million, which is our net income, multiplied by the 30% corporate income tax rate. Next, journal entries in 2021, we have to decrease the deferred tax liability. So, deferred tax liability, 300,000 and credit income tax expense of 300,000. So, the deferred tax liability on December 30, 2021 has a zero balance because the taxable temporary differences is now fully reversed. So, ginamit na yung deferred tax liability. Has been applied. So, income statement presentation for 2021. Income before income tax, 8 million. Income tax expense, current tax expense, 2,400,000. Why 2,400,000? Because the net income is 8 million, multiply that by 30%, and then you have the current tax expense of 2,400,000. You have to adjust the current tax expense on the decrease in deferred tax liability of 300,000. So, how much now is the current tax expense? 2,100,000. So, the net income now is 5,900,000 because we deduct the 2,100,000 from 8 million. Okay, so how are we going to account for the deferred tax asset? So these are the example. In 2019, an entity received an advance rental payment of 1 million which was subject to tax but not reported in accounting income until 2020. So the income tax rate for the corporation is 30%. Oh? So 2019, accounting income subject to tax, 7 million. Taxable income, 6 million. For 2020, accounting income subject to tax is 9 million. Taxable income is 8 million. Okay. Since the temporary difference result to a higher taxable income in 2019, there is a deferred tax asset. No? So, deferred tax asset siya. Journal entries in 2019, no, to record the current tax expense. Income tax is 1,800,000. How do we arrive on this? 1,800,000. We multiply the net income of 6 million by 30% income tax rate. So the income tax payable is 1,800,000. So this is to record the deferred tax asset. Deferred tax asset 300,000, income tax benefit 300,000. So how do we compute this? The 1 million times the 30% equals 300,000. Oh, so we classify deferred tax asset as non-current assets. When it is non-current assets, you cannot claim that during the taxable period, only on the future period. So how are you going to present that in the income statement for 2019? No? So income before income tax, 7 million. Income tax expense, the current tax expense is 1,800,000 and the income tax benefit of 300,000. So you have the total income tax expense of 2,100,000. So that your net income is only 4,900,000. Why? Because you are going to deduct the 2,100,000 income tax expense from the income before income tax of 7 million to arrive at the net income after income tax. Oh? And this is the amount that goes to your retained earnings. So journal entries in 2020 to record the current tax expense. So income tax expense is 2,400,000. How did you compute that? 8 million times 30% is 2,400,000. So our entry there is income tax expense of 2,400,000. Debit, credit income tax payable of 2,400,000. So to decrease the deferred tax asset, we have to debit income tax expense of 300,000 and the deferred tax assets for 300,000. We are going to decrease the deferred tax asset because we apply already the 300,000. So how do we present this on our income statement for 2020? So we're going to present that as income before income tax is 9 million. Income tax expense, the current tax expense is 2,400,000. And then the decrease in deferred tax assets of 300,000. So we have 2,700,000. So the net income is 6,300,000. So our income before income tax, which is the accounting income, is 9 million. Pero yung ating taxable income is 8 million multiplied by the 30%. So we have the 2,400,000. The deferred tax asset and the liability. No? So these are the example. The entity reported the following for the year ended December 31, 2019. Accounting income per book is 6 million. Non-deductible expenses is 500,000. Non-taxable revenue 300,000. Doubtful accounts 200,000. Estimated warranty costs that have been recognized as expense in 2019 when the product sales were made but is deductible for tax purposes when paid. So 400,000. The accounting depreciation is 600,000. Tax depreciation is 800,000. So gross income on installment sale included in accounting income but taxable only in 2019, 100,000. The income tax rate is 30%. So these are the data, no? These are the examples. So how are we going to account that, no? For 2019, how are we going to compute for the tax liabilities? So accounting income per book, 6 million. The permanent differences, non-deductible expenses is 500,000 and the deductible expenses is 300,000. So accounting income subject to tax is 6,200,000. Okay. Deductible temporary differences. Doubtful accounts 200,000. Estimated warranty cost 400,000. And then we have the taxable temporary differences. Excess tax depreciation of 200,000. Gross income on installment sale 100,000. These are temporary differences. So we have to deduct from the deductible temporary differences. So our taxable income is 6,500,000. This is our taxable income for the year 2019. After deducting and subtracting all those permanent differences and deductible temporary differences. So permanent differences do not give rise to deferred tax or deferred tax liability, as we have discussed at the beginning of this topic, that the permanent differences does not give rise to deferred tax or assets or deferred tax liabilities because they are not subject, they are eliminated from the reported accounting income. It has no effect. The accounting income subject to tax must exclude permanent differences. Why? Because they are never taxable. That's why you are not going to reconcile. So, journal entries in 2019. To record the current tax expense, the income tax expense is 1,950,000. So, you are going to credit income tax payable 1,950,000. We have determined or ascertained that based on our computation on the example, the taxable income for the year is 6,500,000. So you are going to multiply that by 30%. So you have 1,950,000 as the tax liability. Number 2, to record the deferred tax assets. The deferred tax assets is 180,000. The income tax benefit of 180,000 you have to deduct. So the doubtful accounts 200,000. The estimated warranty cost is 400,000. The total deductible temporary differences is 600,000 multiplied by 30%. So we have deferred tax asset of 180,000. To record the deferred tax liability, we have to the entry is income tax expense 90,000, deferred tax liability 90,000. And how much is the excess tax depreciation? 200,000. The gross income on installment sale 100,000. The total taxable temporary difference is 300,000 multiplied by 30%. So we have a deferred tax liability of 90,000. Our income statement presentation for 2019, we start with income before income tax of 6 million. And then we have to deduct or add income tax expense. So the current tax expense is 1,950,000. The income tax benefit is 180,000. The deferred tax expense is 90,000. So the net effect to our income 1,860,000 deducted from the 6 million income before income tax. So we have our net income after tax of 4,140,000. Okay? So the accounting income is subject to tax is 6,200,000. So multiply it by 30% equals 1,860,000, which definitely is the total income tax expense for the year. So that there is already a reconciliation between the accounting income and the taxable income. So net deferred tax expense or benefit, how are we going to compute? The difference between the change in deferred tax asset and the change in deferred tax liability is the net deferred tax expense or benefit. No? So example, tax benefit from increase in deferred tax asset is 180,000 based on our previous computation. And the tax expense from increase in deferred tax liability is 90,000. So the benefit and the expense. So the net deferred tax benefit is 90,000. So if the tax expense from the increase in deferred tax liability is more than the tax benefit from the increase in deferred tax assets, then there is a net deferred tax expense. So current tax liability and current tax assets, we have a current tax liability as the current tax expense or the amount of income tax actually payable. So that is classified as current liability. So under the income tax law, income tax for corporation is payable every quarter. So we have the quarterly corporate income tax return that we pay every quarter. So if the amount of the tax already paid for the current period exceeds the amount actually payable for the period, then the excess is recognized as current assets. Why current assets? Because we pay more than what is due. So, sumobra yung binayad natin, kaya asset pa siya. A current tax asset is a prepaid income. Binayaran mo na yun in advance yung income mo, kaya assets. And shall be classified as a current asset. No? So, a current tax liability or current tax asset shall be measured using the tax rate that has been enacted and effective at the end of the reporting period. Why? Kasi ito yung tax rate is mandated by law. No? Presentation of deferred tax assets or liability. Under Philippine Accounting Standards 12, paragraph 70, it provides that when an entity makes distinction between current and non-current assets and liabilities, it shall not classify deferred tax assets as current assets and deferred tax liabilities as current liabilities. Why? As deferred tax assets shall be classified as non-current assets. So, pag deferred tax assets, non-current. Why? Kasi hindi mo siya i-claim dun sa current. No? And deferred tax liability shall be classified as non-current liability regardless of reversal period. Why? Because hindi mo siya ma-apply during the current period. That's why non-current siya. Ibig sabihin, hindi mo siya ma-apply doon sa current period. Also, a deferred tax asset or deferred tax liability shall not be discounted. Offset of deferred tax assets and the liabilities. So, under Pass 1, assets and liabilities shall not be offset unless required or permitted by another standard. So, sa Philippine Accounting Standards 1, assets and liabilities shall not be offset unless required or permitted by another standard. So, there is no offsetting of assets against liabilities. So, paragraph 74 of Philippine Accounting Standards 12 provides that an entity shall offset a deferred tax asset against deferred tax liability when there are conditions. The deferred tax assets and deferred tax liability relate to income taxes levied by the same tax authority. So, halimbawa, tax levied by the same tax authority, BIR, customs, or local governments. So, the deferred tax assets and deferred tax liability can be offset. No? Number 2, or letter B, the entity has a legal enforceable rights to set off a current tax asset against a current liability. So, meron niyang enforceable rights, may law that provides rights to the set off. No? So, may legal basis yung set off. Ibig sabihin, provided by law. So, measurement of deferred tax asset or liability. How are we going to measure? How are we going to value the deferred tax assets or liabilities in our presentation on the financial statement? No? So, deferred tax liability or deferred tax assets shall be measured using the tax rate that has been enacted by the end of the reporting period and expected to apply to the period when the asset is realized or the liability is settled. Example, halimbawa, during the year, the income tax rate is 30%, but the following year, 20% na lang. So, how are you going to compute or measure the tax assets or liability, considering that there is a change of tax rate. These are the example. The tax rate of 30% is applicable to the taxable year 2019. By December 21, 2019, a new tax law has been enacted, imposing a 25% tax rate effective taxable year 2020. The current tax liability or current tax asset is measured at 30%, but the deferred tax liability or deferred tax asset is measured using the new enacted tax rate of 25%. So, current tax asset 30%, pero yung deferred tax asset 25% na lang. So, you are going to reflect the true rate, no, of the deferred tax asset. So, intra-period and inter-period tax allocation. Ano yung intra-period and the inter-period? Intra-period within the period, inter-period between two periods, no? So, intra-period tax allocation, allocation of income tax expense to the various revenues that brought about the tax during the same taxable year. No? The total income tax expense is allocated to income from continuing operations, income from discontinued operations, and prior period errors or items directly charged or credited to retained earnings. So, ito yung iba't ibang klase ng allocations. So, inter-period tax allocation is the recognition of a deferred tax assets or deferred tax liability between different periods. No. So, how are we going to account for this deferred tax assets or deferred tax liability in the statement of financial position approach? We are using the statement of financial position approach. To account for a deferred tax assets or liability, a statement of financial position that shows all the assets and liabilities at their carrying amount is first prepared. So you must have your statement of financial positions. Nandun lahat yung assets, nandun lahat yung liabilities mo. So how is it going to be computed? The following procedures are then followed. Number 1, determine the tax base of the assets and liabilities in the statement of financial position. So, you must have your financial position. Nandoon lahat yung tax base of the assets. Nandun yung mga amount ng assets. Number 2, compare the carrying amount with the tax base. No? Number 3, the difference between the carrying amount and the tax base normally result to a deferred tax asset or liability. Kung iba yung tax base, iba yung carrying amount na nandoon sa statement of financial position, then it will result to deferred tax asset or liability. Number 4, permanent difference do not give rise to deferred tax asset or liability, so do not record. Number 5, apply the tax rate to the temporary differences. Why temporary differences lang yung apply mo yung tax rate? Kasi yun lang yung may effect, no? Na doon sa, yun lang i-recognize mo na deferred tax assets or liabilities. Number 6, determine the beginning and ending balance of deferred tax assets or liability. And number 7, recognize the net change between the beginning and ending balance of deferred tax asset or liability. Now, we have some example. Deferred tax liability, these are the example. Imcan Company report pre-tax accounting income of 5 million for the year ended December 31, 2019. So this will explain all the steps that I mentioned a while ago. The income include uncollected installment receivable of 500,000. The entity installment sales are taxable when cash is collected, as the uncollected installment receivable would not be part of the taxable income kasi uncollected pa siya. So that is the policy of the company. The income tax rate is 30% and the entity had no deferred taxes at the beginning of 2019. Walang deferred taxes. So wala siyang account for the deferred taxes. Okay. So the pre-tax accounting income is 5 million. The installment receivable on December 31, 2019 that has been included in the 5 million is 500,000. we deduct that because the policy of the company is not to recognize that. So we have taxable income for 2019 of 4,500,000. This is net of the receivable of 500,000. So the current tax expense is 4,500,000 times 30%. So we have 1,350,000. So how are we going to record that in our journal? Debit income tax expense of 1,350,000 and then credit income tax payable of 1,350,000. The accounts on December 31, 2019 have the same basis for accounting and tax purposes except the installment receivable, no? Because the company has a different policy on their installment receivable. So carrying amount of installment receivable is 500,000. The tax base is 0 because you are not going to recognize that. So the taxable temporary difference is 500,000. Deferred tax liability is 30% times 500,000 equals 150,000. Why deferred tax liability? Because since the transaction is already consummated, installment sale of 500,000, you already have a sale. So you have to defer your tax liability and on the time that the transaction or the installment sale will be collected. So if the carrying amount of an asset is higher than the tax base, the difference is a future taxable amount and therefore there is a deferred tax liability. Kasi higher yung amount ng assets. Oh? So there is a future taxable amount. The tax base of the installment receivable is 0 because the installment sales are taxable when collected. So hindi pa siya taxable. Example on how to present that in our income statement presentation for 2019. So we have our income tax, income before tax of 5 million. Our income tax expense is, the current tax expense is 1,350,000 and we have deferred tax expense of 150,000. So our total income tax expense is 1,500,000, so that our net income that will be close to retained earnings is 3,500,000. Okay. So Imcan company, in our example, reports pre-tax accounting income of 6 million for the year ended December 31, 2020. This is the following year after 2019. So the accounting income includes uncollected installment receivable of 300,000 on December 31, 2020, and the installment receivable of 500,000 on December 31, 2019 is collected in 2020. So this is the time now that the collectibles on installment sale in 2019 and 2020 collected na. Okay. So how are we going to compute the taxable income for 2020? Pre-tax accounting income is 6 million. Installment receivable on December 31, 2019 collected in 2020, 500,000. Installment receivable December 31, 2020, 300,000 we have to deduct because that will be collectible in preceding year. So we have taxable income of 6,200,000. Multiply that by 30% rate, we have 1,860,000 as our tax expense, no? So deferred tax liability for 2020, we have carrying amount of installment receivable 300,000. The tax base is 0 for 2020. Why? Because it has to be collected on the following period. So taxable temporary difference is 300,000. So deferred tax liability 300,000 times 30% is 90,000. So deferred tax liability in 2019 is 150,000, so that there is a decrease in deferred tax liability now by 60,000, no? Kasi nabawasan, no, deferred tax liability. Journal entries in 2020 to record the current tax expense. Income tax expense 1,860,000. Income tax payable is 160,000. To record the decrease in the deferred tax liability, decrease na yung deferred tax liability natin na 60,000, and then we have to credit income tax expense by 60,000. Okay, so how do we present that on our income statement for 2020? We have our income before tax of 6 million for the year 2020. We have our income tax expense, current tax expense of 1,860,000, decrease in deferred tax liability of 60,000 as shown on the previous example. So 1,860,000 current tax expense minus decrease in deferred tax liability of 60,000. So we have 1,800,000 as income tax expense. Deduct that from the 6 million income before tax. So we have a net income that will be close to our retained earnings of 4,200,000. So the total income tax expense is simply computed by multiplying accounting income of 6 million by the tax rate of 30%, or we have 1,800,000. So deferred tax asset example. Beauty company reports pre-tax accounting income of 7 million for the year ended December 31, 2019. And then there is an unearned rent income of 800,000 excluded from this income. So hindi sinama yung 800,000 na unearned rent income. Unearned meaning binigay na, binayaran na, pero hindi pa na-accrue, hindi pa na-consume yung rental na binayaran. So, beauty company follows the cash basis accounting for tax purposes and accrual basis for accounting purposes. The amount is included in taxable income. So, the income tax rate is 30%. Pre-tax accounting income, 7 million. Unearned rent income, December 31, 2019, 800,000. Taxable income for 2019, 7,800,000 kasi sinama na pa rin niya yung 800,000 na unearned rental income. So, current tax expense, 7,800,000 multiplied by the tax rate for corporation of 30%. So, we have 2,340,000. Our income tax expense is 2,340,000. You have to debit for the journal entries and then credit income tax payable for 2,340,000. Okay. This is another scenario, no? So, on December 31, 2019, the statement of financial position accounts have the same basis for accounting and tax purposes, except the unearned rent income. So, ito yung nangyari. The carrying amount of the unearned rent income is 800,000. The tax base is 0. Why 0? Kasi temporary difference siya, no? So, the deferred tax assets is 240,000. You multiply 800,000 by 30%. We have 240,000. What is the journal entry? Deferred tax assets, 240,000. Credit income tax benefits of 240,000. So, if the tax base of liability is lower than the carrying amount, then the difference is a future deductible amount, and therefore, there is a deferred tax assets. Because the tax base of the liability is lower than the carrying amount. Mas mababa siya than the carrying amount. So, the difference is a future deductible amount. So, there is a deferred tax assets. And how much is the deferred tax assets? 240,000, because we have the tax base of 800,000 multiplied by the tax rate of 30%. So, income statement presentation for 2019. We have income before tax of 7 million minus the income tax expense, current tax expense of 2,340,000 and income tax benefit of 240,000. So, we have 2,100,000. So, our net income for the period is 4,900,000. Beauty company reports pre-tax accounting income of 8 million for the year ended December 31, 2020. The unearned rent income December 31, 2019 is included in the reported accounting income. No? So, on December 31, 2018, the unearned rent is 1,500,000. So, beauty company reports estimated liability for product warranty of 500,000 on December 31, 2020. The warranty cost is deductible only for tax purposes when actually paid. So, for tax purposes, yung provision for the warranty hindi pa nire-recognize. No? So, taxable income for 2020, we have pre-tax accounting income of 8 million. Unearned rent income December 31, 2019, 800,000. We have unearned rent income December 31, 2020, 1,500,000. So, we have 700,000. Warranty liability, 500,000. Taxable income, 9,200,000. So, current tax expense is 9,200,000 multiplied by 30% because our tax rate is 30%. So, on December 31, 2020, how do we compute the deferred tax assets? The statement of financial position account have the same basis for accounting and tax purposes except the following. The unearned rent income carrying amount is 1,500,000. The tax base is 0. The difference is 1,500,000. Warranty liability is 500,000. The tax base is 0. So we still have the 500,000 as difference. And the total deductible temporary difference is 2 million. So 1,500,000 plus the 500,000. The deferred tax assets is 2 million multiplied by 30% tax rate. So we have 600,000 the deferred tax assets. For the deferred tax assets as of 2019, we have 240,000. Increase in deferred tax assets is 360,000. We have this computation a while ago on the 240,000. That is the 800,000 multiplied by 30%. The journal entries on December 31, 2020 to record the current tax expense. So our income tax expense for the period is 2,760,000. The income tax payable credit 2,760,000. To record the increase in deferred tax assets 360,000, credit income tax benefit of 360,000. How do we present that for the income statement of 2020? No? So we have income before tax of 8 million. The income tax expense or the current tax expense of 2,760,000, and we have to deduct the tax benefit, no? The income tax benefits of 360,000. So we have 2,400,000 minus or deducted from the income tax before tax. So the net income is 5,600,000. That will be close to rate and earnings. And the total tax expense is computed by multiplying 8 million by 30% or 2,400,000. So we have reconciled. This is what will happen when you reconcile the accounting income and the taxable income. No? The income tax expense, the current tax expense, and the income tax benefits. So, comprehensive example. On December 31, 2019, the accounts of Jacob Corporation have the same basis for accounting and tax purposes, except the carrying amount of the computer software cost is 4 million, tax base is 0. The difference is 4 million. For the building, the carrying amount is 47,500,000. The tax base is 45 million. So there is a difference of 2,500,000. So how do we account for this difference in carrying amount of the building? So there's no problem on computer software. They're the same. So in January 2019, Jacob Corporation incurred cost of 5 million for the development of computer software product. So considering the technical feasibility of the product, the cost was capitalized and amortized over 5 years for accounting purposes using the straight line method. So for accounting purposes, it is depreciated using the straight line method. Computer software cost 5 million. Amortization for 2019, 5 million divided by 5 years is 1 million. So the carrying amount as of the end of 2019 of the computer software is 4 million. The computer software cost has a zero base because the total amount was expensed in 2019 for tax purposes. So the building was acquired on January 1, 2019 for 50 million. The depreciated using the straight line at 5% for accounting purposes and 10% for tax purposes. So you have to reconcile. Why? 5% for accounting purposes, 10% for tax purposes. No? So building is 50 million. Accumulated depreciation, 50 million times 5% is 2,500,000. So your carrying amount using the depreciated value of 5% in the computation. So the carrying amount for December 31, 2019 is 47,500. The building is 50 million, accumulated depreciation of 50,000 times 10% for tax purposes, 5 million. So the tax base for tax purposes December 31, 2019 is 45 million. No? Computer software, 4 million. The building is 47,500,000 minus 45 million is 2,500,000. So we have the total taxable temporary differences of 6,500,000. So out of the two transactions that we discussed to you on the computer software and on the building, we have the temporary differences of 6,500,000. So that the deferred tax liability as of December 31, 2019 is 6,500,000 multiplied by 30% tax rate. So we have deferred tax liability of 1,950,000. Journal entry. No? So if the carrying amount of the asset is higher than the tax base, then the difference is a future taxable temporary difference, and therefore there is a deferred tax liability. The income tax rate is 30%. So the journal entry, debit income tax expense 1,950,000, credit deferred tax liability of 1,950,000. Why? Because the transaction give us a deferred tax liability, or deferred tax liability arises out of that transaction. So how do we compute the taxable income? If the pre-tax accounting income for 2019 is 10 million, the taxable income is computed as pre-tax accounting income is 10 million. So computer software cost entirely expense in 2019. 5 million minus 1 million is 4 million. Excess tax depreciation, 5 million minus 2,500,000. So taxable income is 3,500,000. So current tax expense, 3,500,000 multiplied by the 30% tax rate. So we have our tax expense of 1,050,000 out of our taxable income na 3,500,000. So how do we present that in our income statement for 2019? Income before tax of 10 million. Our income tax expense, current tax expense 1,050,000. Deferred tax expense 1,950,000. So we have 3 million deductions from 10 million. So net income is 7 million. This net income after tax. As proof, since there are no permanent differences, the total income tax expense is equal to the accounting income at 10 million multiplied by 30% or 3 million. So we have account the differences, or the income tax expense. On December 31, 2020, the statement of financial position accounts have the same basis for accounting and tax purposes except the following. So carrying amount, computer software 3 million, the tax base is 0. The differences is 3 million. The building is 45 million. The tax base is 40,000. The difference is 5 million. This pertains to the depreciation. And then the accrued liability is 2 million. Tax base is 0. So the difference is 2 million. So in January 2020, Jacob Corporation entered into an agreement with the employees to provide healthcare benefits. The cost of such plan for 2020 is 2 million. This amount was accrued as an expense in 2020 for accounting purposes, Healthcare benefits are deductible for tax purposes only when it is actually paid. Okay. So, computer software is 3 million, buildings 5 million, total taxable temporary differences is 8 million. No? Deferred tax liability, December 31, 2020, 8 million multiplied by 30%, we have 2,400,000. Deferred tax liability, December 31, 2019, 1,950,000 in our previous example, computation. So, increase in deferred tax liability is 450,000. Accrued liability healthcare is 2 million. No? So, our deferred tax assets is 2 million multiplied by 30%. So, we have 600,000. So, if the tax base of a liability is lower than the carrying amount, the difference is future deductible amount, and therefore, there is a deferred tax assets. Assets pa siya. You can use it in the future. No? So, journal entries in 2020 to record the increase in deferred tax liability, we have to debit income tax expense of 450,000 and then deferred tax liability of 450,000. To record the deferred tax assets 600,000, credit income tax benefit of 600,000. How do we compute for the taxable income for 2020? No? So, if the pre-tax accounting income for 2020 is 15,000, the taxable income is computed as follows. Pre-tax accounting income, 15 million. Reversal of amortization of software cost of 1 million. Excess tax depreciation, 2,500,000. Healthcare benefits not yet deductible, 2 million. Taxable income, 15,500,000. So, we have the current tax expense of 15,500,000 multiplied by the tax rate of 30%. So, we have 4,650,000, which is our tax expense for the year. How do we record that in our journal entry? Debit income tax expense, 4,650,000. Credit income tax payable of 4,650,000. How do we present that in the income statement presentation for 2020? Income before tax of 15 million and our income tax expense, current tax expense of 4,650,000, deferred tax expense 450,000, income tax benefit of 600,000. The net effect is 4,500,000. Our net income is 10,500,000. So that is our net income after tax. So as proof, total income tax expense is equal to 15 million multiplied by 30% or 4,500,000. So we have that. So in your reconciliation for the income tax return, you can have this computation. Net deferred tax expense is 450,000. Income tax benefit 600,000. So you have a net deferred tax benefit of negative 150,000. Another example for tax purposes is the revaluation example. No? So on January 1, 2014, Jacob Corporation acquired an equipment for 6 million. The equipment is depreciated using a straight line method based on a 15-year life with no residual value. So on January 1, 2019, after 5 years, the equipment was revalued at a replacement cost of 6,750,000. So it is increased. So the income tax rate is 30%. How are you going to account the revaluation of 750,000? So the cost of the equipment is 6 million. The replacement cost is 6,750,000. So there is an appreciation of 750,000. Accumulated depreciation 6 million divided by 15 years times 5 years. So we have depreciation na accumulated 2 million. No? So if we try to consider the revaluation, 6,750,000 divided by 15 years multiplied by the 5 years. So we have 2,250,000 already in the replacement cost, no? Because the amount is 670,000. So we have to use the replacement cost of 6,750,000 in order that we can determine the accumulated depreciation. So what is the appreciation for depreciation purposes? 250,000. So the carrying amount, sound value, or revaluation surplus is the cost is 4 million, 6 million minus the 2 million accumulated depreciation is 4 million. For the replacement cost of 6,750,000, the depreciation is 2,250,000. For the replacement cost, our carrying value is 4,500,000. So there is a difference of 500,000. So how do we compute the carrying amount? Equipment that cost 6 million, accumulated depreciation 2 million, carrying amount January 1, 2019, we have 4 million. For the equipment at replacement cost 6,750,000, we recompute the accumulated depreciation using the replacement cost of 6,750,000 divided by 15 years multiplied by the 5 years that already accumulates. So we have 2,250,000. The sound value January 1, 2019 is 4,500,000. The carrying amount is 4 million. So we have it, the carrying amount of 4 million. Revaluation surplus January 1, 2019 is 500,000. Deferred tax liability 500,000 multiplied by 30% equals 150,000. So we have net revaluation surplus of 350,000 after deducting the deferred tax liability on revaluation. So the revaluation surplus is a future taxable amount and therefore there is a deferred tax liability. So journal entries in 2019 to record the revaluation. Debit equipment of 750,000 because this is the amount of the revaluation. Accumulated depreciation 250,000, revaluation surplus 500,000. To recognize the deferred tax liability on the revaluation surplus, debit revaluation surplus 150,000, deferred tax liability of 150,000. And then to record the annual depreciation subsequent to revaluation, the remaining life of equipment is 10 years. Kasi 15 years, tapos na yung 5 years, so 10 years na lang. Depreciation 4,500,000, 450,000, and then the accumulated depreciations of 450,000. So we have the depreciation is based on the sound value of depreciated replacement cost for accounting purposes. To record the annual realization of revaluation surplus, we have revaluation surplus of 35,000 and then credit retained earnings of 35,000. Revaluation surplus is 500,000, deferred tax liability 150,000, net revaluation surplus 350,000. So our annual realization is 350,000 over 10 years. So we have the annual revaluation of 35,000. So the revaluation surplus is a component of other comprehensive income and subsequently reclassified through equity or retained earnings. Kasi revaluation surplus siya nasa retained earnings or nasa other comprehensive income. That is not an ordinary income. Computation of taxable income. If the income before depreciation and before tax is 3 million, the taxable income is computed as income before depreciation and tax 3 million, tax depreciation based on cost 4 million divided by 10, so we have 400,000. Taxable income is 2,600,000. Current tax expense 2,600,000 multiplied by 30% equals 780,000. So our journal entry, debit income tax expense 780,000, credit income tax payable 780,000. So computation of deferred tax liability on December 31, 2019. Equipment at replacement cost 6,750,000. This is already the revaluation. Accumulated depreciation January 1, 2019, 2,250. Depreciation on revalued amount for 2019 450,000. So we have 2,700,000. The carrying amount of the equipment in December 2019 is 4,050,000. So equipment cost 6 million accumulated depreciation. January 2019, 2,250,000. Depreciation on revaluation amount for 2019, we have 400,000. So we have 2,400,000. So tax base for December 31, 2019 is 3,600,000. Carrying amount 4,050,000. Tax base 3,600,000. So that there is a taxable temporary difference of 450,000. So we have deferred tax liability as of 2019, 135,000. How do we get that? 450,000 times 30%. And we have deferred tax liability as of January 2019, 150,000. There is a decrease in deferred tax liability of 15,000. So how do you account for this? Record in the journal entry, deferred tax liability, debit 15,000 and credit income tax expense by 15,000. So how do you present that in the income statement for 2019? Debit income, income before depreciation and tax 3 million. Depreciation on revalued amount 450,000. So we have income before tax of 2,550,000. We have income tax expense, current tax expense 780,000, decrease in deferred tax liability of 15,000. So we have 765,000 income tax expense. Our net income is 1,785,000. Our revaluation surplus is 35,000. So we have total effect on retained earnings 1,820,000. The total income tax expense is equal to the accounting income of 2,550,000 multiplied by 30% or 765,000. So our total effect on retained earnings is 1,820,000. Oh, so we have accounted that. So for the disclosures, it is very important that the disclosure requirements for income tax are extensive, meaning we have to reconcile. Why? Because the income tax and the taxable income and the accounting income are different. That's why we have to reconcile, and this reconciliation should also be disclosed. So for the components of the total income tax expense, for example, current tax expense, deferred tax expense, and accrued tax expense, we have to disclose that. Also, what are the components of the total income? What are the accounts included in the total income? And then we have to disclose also the explanation of the relationship between total income tax expense and the accounting profit. So this essentially discloses the accounting profit after considering permanent differences. So you have to explain the permanent differences between total income and the tax expense, and also the applicable tax rate. How much is the tax rate for the period? So the basis on which the tax rate has been applied, and the explanation for any change in the applicable tax rate if there is any. So these are the disclosure requirements. And we have to disclose also the aggregate amount of the current and deferred tax relating to items recognized directly in equity, the one that we close to retained earnings. Number 5, that we are going to disclose in the income statement or the financial statement are the aggregate amount of temporary differences associated with investment in subsidiary, associate, joint venture for which no deferred tax liability has been recognized. Why no deferred tax liability or no tax assets recognized on the investment in subsidiary? So we have to disclose. And we have to disclose also the analysis of the beginning and ending balance of deferred tax assets and deferred tax liability. What are the components? What makes the deferred tax assets and deferred tax liability in the beginning and ending balance? So we can have that because we have our journal entries, we have our computation, and we have our presentation. So hindi tayo mawawala. Okay, so this is all for our topics on accounting for income tax. Next time, we will bring you for another episode the accounting for value-added tax. Okay, so, thank you again to our subscriber, and hope you will continue subscribing to our channel, and we hope that we can bring you our updates on tax training, and our aim here is to have a better tax compliance. Thank you and good day.